standardized criteria for what is considered credible and robust net zero targets for corporates. But an initiative called the Science-Based Targets Initiative is working on that framework and expected to release something at the end of this year. Next slide. And as I said, you'll notice that these net zero commitments have exploded over the last year, as noted, some of the headlines on the screen here, as well as some of the stats. Countries responsible for over 60% of global emissions have announced or are considering net zero targets by 2050. Canada and US have such targets as well. And so have over 1,000 companies pledged to net zero emissions by 2050. So all is to say, this is fueling kind of the demand for sustainable finance, and it's about kind of scaling back from heavy emitting activities and mobilizing private and public capital towards low carbon economy. And commitment to sustainability is escalating across many players in the financial system, some asset managers, pension funds, insurers, to commercial banks and central banks as well. And Emile will get into those details later on. Next slide. Yeah, so just kind of walked through that in terms of how all of this is kind of impacting the broader sustainable finance landscape. So it's important to kind of keep these trends in mind to get that broader context. Next slide. So when we kind of look at the broader drivers for the urgent need to mobilize public and private capital towards net zero transition in an equitable manner, we can kind of look at 4 different aspects. The first is, the growing emissions gap, which really underscores the urgency to act. There is a widening gap between current global emission levels versus where we need to be based on what science tells us. Second is, net zero commitments and policy signals. So there's an increasing confluence of climate policy signals, especially with the US stepping up now, and efforts broadly around green recovery spending from governments is expected to have a multiplier effect on mobilizing private investments towards sustainable activities. And there's also expected to be increased momentum around sustainable finance in the lead up to COP26, which is the UN Conference on Climate Change, set to take place in November of this year, a key part of which is something called the Private Finance Agenda, which focuses on mobilizing private finance to support the global economy transition. Thirdly, there is broad scale investor interest. Recognition of climate risk as systemic financial risk is increasing. For example, Bank of Canada is developing a plan to understand climate risks to the economy and the financial system across the country. Investors broadly are also demanding more transparent, standardized and decision useful climate and environmental social governance reporting through frameworks such as Task Force for Climate Related Financial Disclosures, also known as TCFD, and SASB, which is the Sustainability Accounting Standards Board standards. And we would likely need a whole another session to go through the alphabet soup of sustainability reporting standards and frameworks, but recommend you look into TCFD and SASB, as you likely hear these terms come up next week. And it's important to remember that disclosures are part of the sustainable finance ecosystems, as investors are increasingly incorporating and requesting more granular decision useful information from corporates to incorporate these considerations into their decision-making processes. And lastly, there is deepening public pressure and scrutiny. There is the demand for robust action towards urgent decarbonization as public awareness around these issues has grown dramatically. What I'd also like to note, especially in the Canadian context when it comes to sustainable finance, is that I think it's important for us to keep in mind the just transition framing and prioritizing access to sustainable finance for Indigenous communities, which really means that it's important to ask what is the role that finance can play in connecting action on climate change with inclusive pathways so that no one is left behind. So just wanted to kind of leave on that note. And with that rapid, very broad overview, I'll pass it on to Emile to get us into the nitty-gritty of sustainable finance.
Thanks, Puninda. So yeah, hi everyone, my name is Emile. I'm also coming to you from Toronto, which is the traditional territory of the Mississaugas of the credit. Today I'll be speaking really quickly about kind of the basics of finance, the key actors relevant to the trends that Puninda highlighted. So it'll start with basic finance stuff, but then it'll move into sustainable finance. Don't worry, we're gonna get there. But first, if we could go to the next slide, just generally, this is finance. So for a quick recap, if you aren't familiar, on the left-hand side, there are what are called providers of capital. Capital can be many things, but in this case, we're talking about money. And so when you as an individual or a company or a government is not spending money and not keeping it under your mattress in loose cash, you're typically placing it with a financial intermediary. So that's on the bottom. There's a bank or just in a savings account or in a mutual fund or whatever it may be. So a mutual fund might be with an asset manager. You might also do that through your bank. Or for example, you're paying an insurance premium. So then you would be funneling your cash to an insurance company. So these are examples of financial intermediaries that handle your savings and investments. So a financial intermediary is an entity that stands between you and the capital market. And the ultimate user of capital. They do all the technical finance stuff, placing your money in a way to maintain a certain level of return, etc. And then that money goes to the users of capital on the right-hand side, or the spenders, right? So the people that need money. So that could be you and I, if we need student loans or regular loans or a mortgage. We would go to a bank and borrow that money. That money comes from somewhere. So in this case, go back to the left side, it goes from the providers of capital, those entities and individuals that are saving. The users of capital can also be companies and they can also be governments. So typically you'll see governments issuing bonds at all levels of government, right? The city of Toronto does it, Ontario does it, the federal government of Canada does it. A really popular example of a bond was during the war, World War II. Yeah, there were a lot of war bonds issued. So that's an example of kind of governments turning to people with extra dollars laying around to raise money to finance a specific effort. So those are examples of both savers and spenders. And at the top, you'll see kind of financial market. The financial market is just a market where two individuals transact. So you can, as a saver, as an individual, directly interact with a spender, and then that will be a market. So a really good example, back to the government bonds example, specifically with war bonds, you were buying them directly from the government, right? You go to a postal office or wherever. Even now, you can go on the U.S. U.S. Treasury, excuse me, and just buy a government bond directly. So all that to say, you have savers, you have spenders. In the middle, if you want to trust someone to manage your money, you have a financial intermediary. If you do it yourself, you're a part of the financial market. If we go to the next slide, we're going to touch on who we're actually talking about when we talk about sustainable finance in the coming slides. For now, we're focusing on kind of the main actors, quote unquote. So, I'm going to walk through all four, but the bottom three are the ones that matter. So individual investors, that's me and you. We invest and we save. We also borrow. That's kind of our main role in this larger financial market. Then you have institutional investors. So that's the second row. Institutional investor is a catch-all term for any organization that pools money to either invest it, manage it, provide loans, whatever it may be. And they include banks, insurance companies, pension funds, real estate investment trusts. Think RBC, TD, the big five banks, right? Think Sun Life and Manulife. Think BCI and OTPP and other pension funds or pension investment asset managers. These are institutional investors. They're called institutional investors. The only difference with individuals is that they take more than one person's assets or money, and they manage it in a way to reach a certain goal, typically to maximize returns. Then another player below that are companies. So companies, can be public or private. By public companies, I mean those that are traded on a stock exchange, where you and I can buy in via the stock market by purchasing some of their shares, or a privately held company, one that is not held one that is not traded on a public stock exchange, but into which a private equity firm may be able to buy into. So think about, pre-IPO startups like Facebook before it listed on the New York Stock Exchange was a private company. It had a lot of private equity money. There were a lot of investors, including, I'm assuming, institutional investors, but it wasn't a publicly traded company. So examples of publicly traded companies are, Adidas, Siemens, Facebook, all that. The activities that they do are really kind of raising money to do things. So run their companies, build a new factory, whatever it may be. And there are three ways that they kind of build or raise this money, raise this capital. So equity, they can issue shares on a publicly traded stock market, as I just made that example. They can issue debt, so in this form of bonds. Bonds are a contract between an investor and an entity, so a government or a company, that says, in X amount of years, we will pay back this sum with a predetermined interest rate. It's a pretty low risk investment, and it doesn't result in the investor getting a part of the company, right? So that's the difference between equity and debt. When you give money, when you invest in a company and you get equity in return, you are not getting your money back. You're getting a piece of that company. Whereas when you purchase debt, right, so a bond, you don't get a part of that company, but the company owes you money with an interest rate in the future. The similar concept applies to loans, which are also debt. So banks and whatever other asset managers may make loans to companies, and in return they would get an interest rate down the line, but they would not get a piece of that company. So that's equity versus debt. We'll get into it in the next slide. So that's what companies do. They raise capital, and then they also spend it, right? Like they don't just like raise capital for fun. They use it to do different things, pay their employees, build new things, etc. And then the third actor is government. So you have federal, provincial, municipal in Canada. You have states in the United States. You have unions of states, if you think about the European Union. And they also raise capital. They typically issue debt to do so. So government bonds is a good example. And then they invest in projects, or they can make loans to specific entities. So that's kind of who we're focusing on, are institutional investors, companies, and governments. Now we can move to the next slide. So, I touched on this on the previous slide, but for the purpose of sustainable finance, and you'll see later that a majority of the sustainable finance market is made up of sustainable debt. The two key elements to consider are debt financing and equity financing. So that's loans and bonds for debt financing. So again, when I am a company and I go to a bank for a loan, I am saying I will pay back all this money you're giving me plus an interest rate in the future. You do not get a part of my company, but maybe there's a collateral element. So like, if I can't pay this, then you can foreclose on my factory, whatever it may be. Bonds, similar concept, except instead of a loan, you go to the capital market. So you don't go to one entity or a group of entities that may be originating the loan. You go to not the stock market, but the capital market, and you say, okay, I'm going to issue this bond. How many investors want in? And then you cut it up into a bunch of different tranches, and then investors can buy into this bond, and then they will get a set interest rate in the future. Within debt financing, there are two kind of main differences. There's general corporate purpose, which does what it sounds like, right? General corporate purposes of the entity issuing the bond or seeking the loan. So for example, if you're Facebook and you get a general corporate purpose loan, it might be because you want to fix up your building and you got to pay some people and you got to settle a lawsuit and et cetera, right? It typically doesn't go majoritarily to one specific project. So for example, project finance, the other element of debt financing goes over 50% to one specific project. So typically that's the distinction. It varies from institution to institution. So just for simplification's sake, we're going to say general corporate purpose, less than 50% of the total amount that you borrow or raise capital for goes to one specific asset or project or activity. In contrast, for project finance, these are large projects that you raise capital for, either by issuing a bond or by seeking out a loan. It's a whole world of itself called project financing. It's a very specific type of finance. Within that, these are huge deals, like hundreds of millions of dollars, typically, or tens of millions, which is still huge. And a majority of the amount raised, either by the loan or by the bond, goes to that specific project. And then typically the returns on that project are what helps the entity pay back that loan. So a really good example is a pipeline, like an oil and gas pipeline. If I go to, let's say, 5 banks and I'm like, I want a $100 million loan, and all of it will go to this pipeline, let's call it project financing for pipeline X, the amount that users of this pipeline pay me, the company that built it, will then lead me to profit, and then I will use those profits to pay back this loan specific to this pipeline. That's the idea behind project finance, right? And again, it varies. All of these things can change. There's no set law about what is or isn't project finance. It's all norms. So these things are evolving over time as the market changes. And then separate from debt finance, right? There's equity finance, which I already touched on, where you get a share or a percentage of the company by providing financing to that company. So, a startup, you buy in, think of Dragon's Den or Shark Tank when they're like, I'll give you 20 grand for 7% of your company. That's equity financing. If we go to the next slide, we can touch on examples of what gets financed. And here's where we tie into sustainability. So, looking at debt financing for general corporate purpose, it could be a firm doing sustainable things like a solar company, firms doing not necessarily unsustainable, but not necessarily sustainable things like a grocery store, Facebook, whatever. Firms doing unsustainable things like building net new greenfield oil sands mines, a new coal-fired power plant, whatever. And then project finance, the financing would be specific to the project at hand. So for example, if Enbridge got a loan for line 3 right now, that's not necessarily sustainable. Siemens, as an example, if they got a loan specifically for a wind farm, that's pretty sustainable. And then another example would be like Nike getting a loan specifically to build a factory for clothing using repurposed materials. It's like, okay, that's net new consumption and there's a lot of supply chain emissions, but it's using repurposed materials. So it's kind of a gray area. For equity financing, it's general corporate purpose. So it really depends on what the company does. And then the takeaway from this is just like sustainability isn't clear cut. And to Puninda's earlier point, there is increasing investor demand and interest in sustainable finance. So if we go to the next slide, you'll see that investors and lenders want to finance sustainable projects. Either they have updated mandates or they see the opportunity to make a lot of money there, right? Like renewable energy is a growing market as one example. Or it's risk management, right? The way that they're perceived. I don't know if you've seen, but lately there's been a lot of activism, specifically around the big 5 banks in Canada, around their financing of the oil sands. So it could be a risk or a reputation management element to invest in sustainable projects to offset this poor reputation. Or it can simply be risk management, right? Like climate risks are real risks. The transition to a low carbon economy does present a risk to a portfolio that is heavily exposed to oil and gas, for example, or coal, right? If you lend 30% of your loan book is to coal-fired power plants, and you know that in 20 years there won't be any coal-fired power plants anymore, that means that that's 30% of your revenue just out the window. That's a risk to your profitability. You should definitely evolve your business model. And so this creates a demand for more sustainable alternatives, or at the very least, investments and loans that could be resilient in a low carbon future, right? However, this is people's money, right? Like either you're a pension fund and you have a very serious mandate to manage people's retirement money. You really can't mess it up. It's they take it very seriously. Or you're a bank and you got quarterly earnings reports and you got to really show profitability, but you also don't want to get accused of fraud or misleading the public. So these investors and lenders really want to know that the things that they're investing in are sustainable, green, social, transition, to a net zero future, or sustainability themes. And again, this recurring issue of sustainability isn't clear cut, and these definitions aren't regulated. So how do you move forward, right? Like, what's the solution? If we go to the next slide, we'll see that there's a two-part solution, right? So you can identify and assess ESG issues, which are environmental, social, and governance issues. That falls under the bucket of responsible investing, or investing or investment. So you take ESG issues, so that might be the company's relationship with labor organizations, right? For example, Amazon is having a really bad run right now where they're kind of union busting and having a lot of discouragement of union votes. So that would reflect poorly on the social factors, right, within this ESG. So responsible investment, and specifically ESG integration, means that it's a part of due diligence or risk management, depending on where it sits in your firm. You can look at a loan or an investment, and before you do that, you say, okay, the stock has been going through the roof. Do we think it's a good long-term investment? Okay, well, let's look at non-financial factors, right? ES and G factors that have been demonstrated over time, and increasingly so, to have an influence on stock price, on access to capital, et cetera, to really assess if this is a long-term viable investment. So another good example would be Tesla, right? Could be labeled as green, and their stock has been going through the roof, but again, they've had a bad run on the social front of things, especially with long hours and labor disputes in some of their factories. So you look at that and you're like, all right, well, is that a risk for litigation? Are they going to get sued? Are they going to get regulated, or whatever it may be? You take these ESG factors and you integrate it into your decision making. That leads, or you have sustainability rating agencies. So Sustainalytics, Rep Risk, that have their own way of assessing a firm's sustainability or ESG score based on kind of a black box assessment of how they see their performance. This enables asset managers, banks, to provide exchange traded funds or mutual funds that say that are ESG aligned. What that means typically is they'll take the sustainability disclosures that Puninda mentioned before, TCFD, SASB, CDP. They'll look at the sustainability rating agencies such as Sustainalytics and Rep Risk, and they'll come up with typically like an equation or a methodology to really say, okay, only firms that perform well on these 7 factors can then be included in this ESG aligned fund. That typically just means that this company is not terrible on X, Y, and Z, not necessarily that the use of the financing that you're providing is green, social, sustainable. A really good example is that, ESG analysis typically happens within a sector because you can't compare apples to oranges. So you can have an oil and gas company with a high ESG score because relative to their peers, they treat their employees really well, and they recycle, and they have a paper reduction program, and their board governance is really well set up. But they nevertheless are an oil and gas company, and unless they are transitioning to be more resilient, they would be hard pressed to raise kind of green or raise financing to finance specifically green projects, right? So that's the first element, is ESG integration. But as I just mentioned, it has some shortfalls in that it doesn't really touch on the use of the proceeds of the financing. And use of proceeds is a finance jargon to mean what you're using the money for, right? You can be well rated on the ESG front, but if you're not using the money to do sustainable things, it's very hard to be considered sustainable, like that financing to be considered sustainable, right? So let's move to the next slide and really focus in on, okay, well then let's define what sustainable means. And as you'll see on the right-hand side, sustainable finance is this huge bucket that includes ESG investing, which is what I just described. And like a series of Russian nesting dolls, the more narrow you get, the more specific and the more quote unquote impactful you are in these different categories. So social finance, right? I'll define it in a second, would focus specifically on social issues. What this layering means, right? The dark blue is sustainable finance, the light blue is ESG investing. What that means is like you go through that due diligence screen and say, okay, this company performs well from an ESG perspective, right? Like they disclose all the things they should disclose, et cetera, et cetera. And then in addition, for it to be social, they drive an impact on access to education or access to healthcare. Similarly, with green finance, this project or this company or this asset drives to a reduction of emissions in some way or other. The terms that are used in this world are on, 2A, you'll see on the left-hand side of this, the slide, sustainable, sustainability themed, sustainability linked, green, social, and transition. And these are defined either by regulation or by industry norms. And industry norms are typically led by industry associations. So if we go to the next slide, just very quickly touching on what counts, how things are defined as sustainable or sustainability themed, sustainability linked. So the word sustainable doesn't really have a definition. As I mentioned before, it's a tricky word. It's more of a spectrum or a lens to use than an actual thing in and of itself. In terms of regulations, the EU just released the EU Sustainable Taxonomy. Taxonomy is jargon to mean a list of activities and projects that the EU considers as sustainable. Happy to get into that later, but so that's a market in which sustainable is regulated. The government says this is what is sustainable, and then anything that doesn't fit within that definition is not sustainable by definition. Sustainable is also defined by norms, right? So a good example would be alignment to the UN Sustainable Development Goals. So if you can demonstrate that your fund aligns to certain SDGs, then you can make the case that it is sustainability linked. Or if the bond that you issue positively impacts one of the SDG topics, you can also make that case. And then the ISO TC 322 is the International Standards Organization, which is this non-governmental body based out of the UK that sets definitions for the world, right? Like you'll see it on just like household objects, that you'll see either a CSA or an ISO, and that just means that everywhere around the world things work the same. That's why your USB that you buy in China can work in France and can work in Canada, and AA battery kind of means the same all over the world. These things are standardized. So they are working to standardize what sustainable finance, or sustainable in the context of sustainable finance, means. It's a work in progress, and it's not completed yet. But once that's done, the idea is that this will be a normative definition that will not be regulated, but that will be adopted by the industry. So that's sustainable at a high level. Sustainability themed is things that are themed to align typically with a UN SDG. So an example that I provide is a women in leadership bond. So if you issue a bond that says we will, we're a bank, we're going to issue a bond, and within this bond, all the money that we use to pay you back with are loans to companies whose boards have a diversity percentage of 40% and up of women on the board, for example, right? That would be sustainability themed. It wouldn't be driving sustainable outcomes per se, but it would have the theme of rewarding certain entities, in that way. Then there's sustainability linked. So that is when a company has sustainability targets and the bond or the loan has a like a cost of capital reduction. So like your interest rate lowers if you meet your sustainability targets that you agree to when you get the loan or you issue the bond. And then moving to the next slide, green is defined in a normative way, by the industry associations. So there's green bond principles, green loan principles, climate bonds taxonomy. It's fairly clear cut. Are you mitigating emissions? Are you, adapting? Then social bonds and loans are also being defined by these industry organizations this is less clear-cut than emissions because social captures so many different things, including access to clean water, healthcare, and housing. It's an evolving definition and framework, but it nevertheless is somewhat crystallizing. So for the transition, that's the last remaining definition, and it is a work in progress, right? This is the big one. This is what matters. It's easy to say, oh, I'm building a wind farm that's green. The entities that are green, will exist in the future, but to really reach the Paris Agreement targets, we need to transition the entire economy, including the heavy emitting sectors. So the way in which transition will be defined really matters for the next, 20 to 30 years. And if we go to the next slide, you'll see that kind of putting all this together, there is a growing sustainable finance market. The words that are used to define the different types of financial products used are green, social, sustainability linked, sustainability themed. These exist and have fairly concrete definitions. The definition of sustainable in the context of sustainable finance is still being developed in a normative way at the international level, and the definition of transition is still being developed as well. And this matters because the way in which transition will be developed will impact governments, companies, and investors who are seeking out more sustainable areas to place their money or capital. And so that's it for me. I'll pass it over to you, Alan.
All right, we're going to blitz through a bunch of clean tech super, super fast, take a little bit of a 90-degree turn, and chat about finance in an innovation context. And we'll take this as a little piece of how do we finance some of the new technology solutions that we need to link into our SDG goals. Linking into Emile's point about things being super fuzzy, clean tech is also a super fuzzy definition. And so these are two variants of the clean tech definition that you might see floating around. The more traditional clean tech definition of any process, product, or service that reduces environmental impacts. And then the emerging one that you'll see more and more of, which is specifically looking at climate tech, so linking that to greenhouse gas emissions and impacts of climate change. Now, it's an ongoing conversation as to how these two fit together. I think the easiest way to picture them is as partially overlapping, so around some of the sectors we associate as being both clean and climate focused, like clean energy and transportation, and then some areas that don't quite overlap. One way or another, climate tech is probably going to be our dominant term as we venture into the next few years, in part because the finance community has a conflicted history with the term clean tech, right? Clean tech has some negative associations from the clean tech bubble around 2008 with the recession. And so unfortunately, there were some unsuccessful investments in the clean tech space, particularly around Silicon Valley finance. And so climate tech is this emerging new wave of finance investment. So let's call it a rebrand and look at what that rebrand does for us. We've chatted about SDGs already, so I'll skip past that. But SDGs are the language that is now not only helping finance to link into our broader global task list, as Brianna calls it, but also in terms of looking at our innovators and our accelerators and how we're linking into some of the technological challenges tied to those SDGs. So this is Climate Ventures, which is an accelerator based out of Toronto, and you can see that they've got some fantastic organizations that are linking in explicitly to what are the SDGs that they are supporting through their work. So 2019, a little bit of a slow year for venture capital, but in general, you can see that this is climate tech, and climate tech investment has gone through the roof from 2013 to present. And a lot of that has really come from transport. So EVs, right? It's hard to look anywhere without hearing about electric vehicles, and all of these emerging markets around that. So transportation is one big subsector of our climate tech world, as is ag tech. So anything to do with agriculture. And we'll see a lot more of these subsectors, including industrial processes, advanced materials, built environment emerging over the next few years as well. In Canada, this is kind of hard to define. You'll probably see a few different numbers floating around depending on how we actually define clean tech. But Canada definitely punches above its weight with respect to clean tech, with 12 Canadian companies in the Global Clean Tech 100, and I would say fourth globally based on rankings, largely looking at our early stage innovation ecosystem around clean tech. And in terms of our goals, this is very much a growing sector for Canada. This is a growing sector, both in terms of looking at how do we support the goals that Canada has around SDGs and net zero with the appropriate technologies to get there, right? And scaling the kinds of energy or transportation systems that we're looking to design. But also the other piece of that, which is when we talk about divesting or moving away from unsustainable investments, what are we investing in? And so clean tech really represents an opportunity to build a new sector, new jobs, and new revenue in Canada. Now, one key term to think of on the innovation side of things is technical readiness level. So that's TRL. And that really just speaks to where technology is along its path from TRL 1 being basic research to TRL 4.5 lab testing to TRL 9, which is a system that is ready for full scale deployment. So depending on what we're talking about for clean tech, whether it's software that can iterate very quickly and go from TRL 1 to TRL 9 in someone's garage, to a power plant, right, with technologies that are high risk, need a lot of capital up front, and potentially years to get from TRL 1 to TRL 9, this is definitely hard to compare apples to apples across various clean tech sectors and companies. But in general, there's a couple stages that we can talk about with respect to clean tech financing. The first is our pre-seed stage, where we're typically raising thousands of dollars. And a lot of that starts out with the individuals that Emile mentioned. So typically 3 Fs, friends, families, and fools is what it's known as. So a lot of early founders are putting their own money into their idea or their venture and pulling in money from their networks. Now, once we get into seed funding, we're looking at hundreds of thousands of dollars. And at that point, we'll pull in high net worth individuals like angel investors, right? Or family offices. So folks who have money floating around, but might not be institutions with particularly specific policies around, here's what we need, return on investment, here's what kind of companies. So a little bit more flexible in terms of their funding pools. And then we start looking at the big money. So Series A, Series B, Series C, Series D. All this is saying is we're gradually increasing the pots of money that we're pulling in, and we're increasing from individuals to now institutional funders. And that's where venture capital comes in. These are just the institutional funders that are able to support at that $1 million and up level, all the way to an IPO, which is a company going public. This is not the only way that a company sort of successfully exits. There are many Canadian companies that are typically bought out somewhere before the hundreds of millions dollar mark. But this is what a lot of companies would be aiming for their trajectory from start to finish. And in Canada, this is a really useful report, by the way, a Globe Capital report from 2019 around clean tech. You can see that there's a lot of really great early stage government support. So if you look at sources of financing, which is that bottom row, there's a lot of very great government programs like SHRED and IRAP and SDTC that funnel money into early stage ventures, especially on the clean tech side. The valley of death is something that you might hear about, and that is really that challenge of going from demonstration to commercialization, right? For a lot of clean tech, it's quite high risk. You might be developing something that's never been done before, or taking a very new spin on something that requires years to pay off. And so where a lot of clean tech companies face challenges, especially in Canada, because there's not as much private capital, there's not as many venture capital firms or private equity firms that are open to that kind of risk on the clean tech side, is there's this valley of death where a lot of clean tech firms just struggle And many of those firms are struggling, in particular with debt financing. So Emile talked about the debt side of things. So a lot of these firms, before they ever show a return, there's a lot of capital expenditures that they need to take on. So capital intensiveness is one, risk is another, debt financing, and export is the only other one that I'll pull out of here, which is the fact that in Canada, we just don't have an ecosystem to be able to use a lot of the technologies that we produce. In part, we're kind of risk averse. If we look at the kind of procurement practices that companies have and governments have in Canada, we're not the first ones that are trying to use some of these innovations. So that means that a lot of these companies are looking to export markets and are looking to export markets fairly early on. Here are some of the clean tech opportunities that were highlighted in that Globe Capital report. And a lot of that is really just building stronger networks, particularly around blended finance. So how do we use public money and private money together to support companies better? And then stronger networks so that especially your early stage companies are able to access funding when they need it and in the form they need it. I'm not going to chat about the water space just because we're short on time. So I will wrap it up there. And I think I'm going to hand it back to the team to wrap up.
Awesome, thank you. So yeah, we've just got a couple of minutes left before the top of the hour, which we have a hard stop. So maybe time for one question. Yeah, if not, I think we'll connect you guys with the presenters as well. So if you have a question for me, send it to me, and I can forward it on that way, and so we can make sure you can get any additional questions answered. All right, so that brings us to the end of today's session. Thank you all for attending. Just a quick reminder before we go, we have got another session tomorrow at 11:30 a.m. Eastern with George Benson on sustainable infrastructure. So if you're available, we highly encourage you to sign up and attend it. Otherwise, we'll make that recording available to you on the Leading Change Visivo site as well. Okay. And then finally, make sure you join the LinkedIn group, as well as follow us on any social channels that you use. And we highly encourage you to use those hashtags, hashtag LC2021, to share your experience. Okay, that was short and sweet, but we hope you got a lot out of this. I know I did. So thank you, and we'll see you next time.